Hello everyone and welcome to episode 174 of True Potential's Do More With Your Money podcast. Suited and booted crew we have today for you. We've got Craig Almond, we've got Luke Johnson-Bolton and Jeff Casson. And today for the next 20 minutes we're going to be looking at investing close to retirement. Now we are told that the average age of the person who views this is 55. So if you're not 55 yet, please don't switch off because there's going to be a lot of interesting talk around pensions. And I think that 55 is the key age because under pension freedoms, gentlemen, that's when people can start taking a pension. But it's not always the best time to take it. And I think that what we've got to look at today on behalf of our viewers and clients is just the options around retirement. And if we could begin with you, Luke, 2015 seems a long time ago.
It does.
But George Osborne shocked the financial world, but also gave freedom and choice to an individual.
So it was a big change. So historically, a lot of clients at that sort of age mark, 55, they've always thought that, you've got your pension and you have to take your tax-free cash when you retire or when you take your pension. And one of the big changes brought in by George Osborne was that you can take the 25% tax-free cash. You can take some of it, you can take all of it, or you can leave it, you don't have to touch it at all. So it's important you think about retirement. When you're 55, you may still be working, you've got enough income, you might have assets elsewhere that are more efficient to use. You could leave your pension, you don't have to take the tax-free cash. Likewise, if you wanted, a big holiday, if you wanted to go out with your family or treat the kids or whatever, you could take, say, 10% tax-free cash. You could leave the rest invested. So it's always good to speak to an advisor, really get in mind your goals and look at when you want to retire. Remember that the pension actually is a very tax-efficient tool, but it's also very flexible. You can take as much or as little as you need, and actually we would always recommend leaving that until you actually do need an income from your pension. So yeah, speak to your advisor, look at the ways that you can take tax-free cash and income. That means you can take a lot from your pension in a tax-efficient way. You don't have to take all the tax-free cash at once, and you don't actually have to touch the pension until you need it.
Yeah, and I think that again, convention suggests that a pension is the only source of retirement income. That's the way it has been. And if you look at the way things have changed over the years, everybody thought they were going to get a state pension at a certain age. That age keeps moving further and further out for the majority of people, which is why it's quite important that you don't just rely on that. You start saving as young as possible, Jeff.
Very much so, and I think the other thing about thinking about starting to save as young as possible is just that power of compounding. So little and often over a longer time period really does make the difference. And I think for anything, I would always encourage anybody to start as young as they can. Yes, it might be that you want to think about how I want to spend at that point in time, but actually starting early, by the time you get to that 55, that can make a big difference to the size of the pot that people have available as well.
And Craig, there's a debate goes on, what is the most effective savings vehicle? An ISA or pension, or do you just leave it, as say, in a general investment account and let that money build and compound, as Jeff just said?
I think for me, a pension, especially if you're looking at clients who are working, if we're looking at the tax relief going in, that's only exclusive primarily to a pension. So unlike an ISA where you invest in taxed money, with the pension you're getting tax relief at source, you're able to claim that money back, and there's only ever then a tax liability due when you're drawing that money out, again exclusive from the tax-free cash. So clients can be extremely clever and really use pensions to their advantages, not only when they're accumulating money, but also when they're decumulating money, in terms of managing tax liability, minimising tax, but also maximising legacy funding for beneficiaries, but also just their standard of living whilst they're in retirement and enjoying their life after working so long to accumulate such a pot.
Okay, so let's look at an individual then who's approaching 55. They've got various investments in there. Let's say there's an ISA, there's a pension, and there's money in the bank in savings. If we were to give that person, sit down and say, right, these are the options you should look at, where do we begin to start?
I think for me, primarily, and this comes down to a lot of planning that Luke and I have done, particularly we're looking at final salary pensions, is we look at the lay of the land, the assets the client's got, and really take a holistic approach. Again, pensions traditionally, clients default to thinking I'm retired, I'll draw my pension, but in reality, if we look at the asset classes and certainly the product wrappers that are available, cash is probably going to be the first thing we look to access. So we'd always want to ensure clients retain an emergency fund so that we're not, if anything crops up where they need capital, that's instantly available and can meet those needs. But if there's excess cash sitting in deposit accounts, that's going to be our primary kind of source of income initially. Once we kind of decumulate that to a certain level and hit that emergency fund, we then look at ISAs and the likes because of that inheritance tax kind of benefit which comes with the pension. So an ISA is tax efficient in the fact that you've got no capital gains tax and there's no income tax when you're drawn down in that fund. But if you are a client with higher net worth who has got an inheritance tax liability, ultimately that falls into your estate, whereas a pension doesn't. So when we're looking across the board, pensions and ISAs are both free from CGT, but you only get the inheritance tax relief within a pension, whereas you don't within an ISA. So it is very kind of linear in terms of the way we structure retirement income when we're looking at clients' assets.
I think that's a really good point, Craig. And I think the thing is with inheritance tax that a lot of clients don't realise is that if you are married with children, the main residence nil rate band is £1 million. You know, it's a lot of money, but if you look at the average house price in the UK, it's 300,000. But if you live in London or down south, you know the average property price is much higher. So just by having a property in London, you and your family could fall foul of this inheritance tax issue, whereby any of your assets, that's ISAs, house, cash, as Craig mentioned, or GIAs, that's going to be taxed at 40% on death, whereas a pension is completely outside of the estate. So it's a really good point Craig makes, and actually a lot of people will be trapped by this inheritance tax issue without realising it just by having a property that they may have bought.
Yeah, and what we've highlighted over the past couple of minutes there is just the flexibility that's involved in pensions now, whereas at one time it was a locked asset. It's no longer locked. And I think, again, the power of the individual comes through very, very strongly when we're giving advice at that point of time for everybody. And also the choices that they have for a retirement pot have changed dramatically as well. Whereas one time you were locked into, say, a company pension, you couldn't do anything about it, you had no say over how it was invested or how you could access it, or indeed the benefits that you could take from it. Whereas now it's much different. And Jeff, we see that on the investment management side when we're looking at different portfolios, doing different jobs for people at different stages of life.
I think that's a crucial point, because the freedom is there for people to think about whether they want to use an income portfolio or whether they want to use a growth portfolio as well. Because I think the thing that we can all forget is that somebody at 55 might have a life expectancy of another 30 years. So you kind of have to think about that from 25 to 55. You're trying to grow the assets, but in the same way, as you move into that drawdown phase, you want some form of asset growth as well. But also on the income side as well, use ways of taking more natural income as well, using the income portfolios, and something that's, I suppose, quite pertinent at this point in time when we think about where yields have moved to, where the income opportunities have moved to for an income portfolio. Yes, we talk about how gilt yields in the Bank of England rate have moved up, but that's also allowed the yield on corporate bonds to move up because we earn a spread over and above the risk-free rate or that Bank of England rate. So the options there to bring natural income into solutions is also there. And that's, I think, very much the role that the income funds can potentially play, and are maybe underused in terms of generating that natural level of income, because they haven't maybe over the 15 years post the financial crisis been able to bring that level of natural income that would be required, whereas our starting point today with a base rate of 5% allows a different income portfolio to deliver income as well.
And you talk about natural income. We understand the term.
Yeah.
Just explain a little bit more about that.
I suppose what that is, it's just the income that's been generated as a result of the investment. So that which is coming through from the ownership of equities in terms of the dividends that will come through, but also in terms of the corporate bonds that we would own in terms of the coupon that they would be paying out, so the interest that we earn by lending money effectively to companies on behalf of our clients.
Okay, and is it fair to say that when interest rates go up, generally the yield, the income that's produced from the bonds, depending on when you buy them, that goes up?
Yes, exactly, and that's certainly what we've seen in the market over the recent period, and that's one of the, I suppose, the consequences of interest rates moving up. So the income that bonds are generating is more attractive at this point in time, and that does feed itself through into the coupon that people are able to pick up. Now depends on I suppose a couple of other factors when the bond is issued, and also in terms of the coupon that's attached to that. So it's still very much about actively looking for those bonds that are attractive, and that's certainly what we see with our income managers, where they are able to very precisely target the type of duration that they want, so the length of the bond, but also the income profile that comes with. So you will get an appreciation of the capital growth, but also the potential income as well.
Okay, so from the client point of view, again, I'm coming back to this idea of individuality. If we have somebody invested in a pension and they're 50, they can have it in a growth portfolio, and then they could switch all or part into an income producing asset, take that income, use that to enhance retirement spending, but also keep the asset locked into the pension in order to benefit from the capital gains tax advantage and the inheritance tax advantages.
Yeah, exactly right. I think the big benefit of the pension being free of capital gains taxes, there's no cost or tax implications for changing funds as your strategy or as your lifestyle changes ultimately as you go through retirement. And I think a big part of pension freedoms ties into that is ultimately giving, as you said, clients a choice to utilise their pension as they see fit. And you could look at it as, do I need to spend all my money? Do I want to leave it for me beneficiaries? Ultimately, it's your pot, and you can use that exactly how you want. And I think that's the big thing to come out of pension freedoms, is giving people that choice, that freedom that previously wasn't existed. They couldn't do it. It was through traditional annuities, scheme pensions with no legacy benefits.
Yeah, and on scheme pensions, once you've started to draw benefits from that, that's it.
Yeah, rigid.
Whereas a personal pension is different.
Correct, Mark. I think everyone who's contributed to national insurance will have state pensions, so that's currently 67 when you will receive that, and obviously that's due to rise. So say if a timeline of retirement, you're 60 and you take a scheme pension or a fixed pension. If you're married, there's going to be a time where between you'll have at age 67 21,000 of secure state pensions or more. And if you have a fixed pension at that time, you could be classed as a basic or even a higher rate taxpayer because you've got that fixed pension. With a personal pension, you've got that freedom to take more between the ages of 60 and 67. You can then reduce the income, you can change the attitude to risk, and you can look at leaving some to your family. And it's a lot more flexible in that way. There's obviously tax advantages in being able to turn the income off and make sure that you don't pay a lot of tax in retirement.
Yeah, it all makes sense. It always has to be remembered that the purpose of a pension is to provide an income in retirement. And we've talked about 55. That's the earliest possible access point. It's changing in the next few years to 57. But again, you don't have to access it. You can take that money when you want to, when suits you, when suits your circumstances, and when it suits your family. And it's at times it can be difficult to plan. But one thing that flexibility gives you is the ability to be able to suit whatever you've saved for when you draw on that to your own personal circumstances.
Yeah, I think that's exactly right. And as well, obviously, I think if we look at certainly company which we've had, it's definitely a long-term investment. And I think if we look at ourselves in the building in terms of how serious we take investing, it's something which we're very much on the ball with. And I think we understand the responsibility of looking after clients' money over a long term. And I think if we look at the short term, we're uncomfortable, and we understand the choppiness that's in the market and the volatility that goes along with that. We're all investors ourselves, so we fundamentally understand and appreciate that, but we are calm and relaxed in the sense that we know long term there is a premium to be in risk-backed markets, risk-backed investments. And I think we've only got to look at our own portfolio since inception and the annualised return they've given, that over the long term it does pay to be invested. And a pension, for example, is certainly a long-term investment, and you're there to make money, we're there to make money, everyone's there to look to make their money work for them. I think that's clear to be reminded of. We are volatile short term, and that will potentially impact your retirement plans, but it is a long-term product, and that's something which we need to reiterate to ourselves and also clients. It's not something short-term, and I think Luke touched on it really candidly a few weeks ago, so I think it is just worth reiterating. It's a long-term game. We know markets can be choppy and it can be uncomfortable for investors, but over the long term, asset-backed investments will prevail.
Certainly, volatility has been something that we've all discussed and we've all experienced on our investment journeys. It is volatile at the moment. We can see that in terms of the profile and how markets move from day to day. But it's also, I think you're completely right, Craig, thinking about the long term is that the academic evidence, the market evidence, it supports investing for the long term, but also setting your goal, and which is also very crucial to what we want to achieve with our investors as well. And it's about navigating that, ensuring the portfolios are appropriately diversified, that they are there to navigate their way through that different levels of volatility. And certainly in the period that the portfolios have been, there have been very volatile periods, and we've navigated our way through it. And I think that's a crucial point to really reiterate.
I think it's a good point, Jeff. I know you mentioned the average life expectancy. So if we cover that off again in numbers, it's 84 for a male and 87 for a female. So if we look at 55 as an age, that's 30 years, even when you're in retirement, whereby you're going to remain invested. So again, it has been volatile over the last 2 years, but it's important to take that big picture, which we always take, and say, so if we do cash flow forecasting, we look to age 100 to make sure that clients have enough money. And it's going to be a long, 30, 40, 50 year time period, even when potentially you are retired, when you're going to remain invested.
And I think that's to come back to something that Mark said at the start around where, yes, interest rates have moved up, but that moves up the risk-free rate for all assets. And it does then present, in certain and particular assets, different opportunities.
Mm.
And that's something that hasn't been available over the last 10 to 12 years as well. So that different income dynamic, I think, is also worth bearing in consideration, given the backdrop that we've got at the moment.
Yeah, and also, Jeff, looking at the way, let's say, institutional pension funds or occupational pension funds are run, they're invested in the market. Mm-hmm. A true potential pension is not the only pension.
Certainly not. And I think one of the things is that probably a lot of people look at it all of the time, and we just have to accept that there is volatility in asset prices. I think when we see it daily, you want to think about it daily, but I think the key thing there is to take a step back and think about, well, actually, that's normal, but over the long term, it's the return that I want. It's looking at the shape of the chart over the long term is the most important aspect. And I suppose the thing there is that when we're talking about long term, we're not talking about 2 years. Mm-hmm. We're talking 3, 5, 7, 10 years, and that's kind of the period that we need to be thinking about when we're looking to achieve the goals that we have.
Yeah.
It's not about the movement over a relatively short period of time.
We were doing some planning years ago on some software within the platform, and looking at pension and trying to make it simple. We said, right, there's 2 phases. There's the accumulation phase, which was termed the high jump, and then there was the long jump, which is the deaccumulation, or in everyday language, just drawing on your pension. And it's how long that period lasts. And yes, we talk about expectancy, age expectancy, etc., but nobody knows. So again, I come back to individuality. That's really what we're offering here. The fact that under pension freedoms, people have been able to make that choice that was previously not available to them. And a lot of thinking hasn't moved from 2015. You're still in the old way of thinking that when I retire at X age, I will take Y out of my pension. That doesn't have to happen anymore, because we can take into account all assets and give advice, and the advisors using True Potential can give advice over the best way to access a savings pot and make it last for as long as possible.
Exactly right. I think as well, if we look historically, there was winners and losers. So if you're a client who's paid into a pension for 30, 40 years, take an annuity and God forbid anything happened to you in the short term, the pension scheme ultimately won in that case. They've got all your money that you've spent years of hard work accumulating. Within their pension freedoms and personal pensions, you've worked hard to make that money. You're ensuring that on your death, that can pass on to your family, and that money's not lost to a pension fund as it has been historically. And that's a really important difference to make between existing company pensions or annuities in comparison to what we're dealing with now. It opens the book up to clients, allows them to retain more wealth for themselves, but also their families. And I think that's probably a real prominent feature of pension freedom since 2015 that previously wasn't around.
Yeah, and we've been encouraging people who've got pensions with us, clients who are investing their long-term future with us, to think about the next phase as well, under a beneficiary program. And we've covered that on previous podcasts, and it's something we're seeing more and more. Parents primarily saying, right, I'd like my children to be given a degree of financial awareness now, so that when it comes to a point in future where they start inheriting money, they've got an idea about the responsibility of holding that money and how it can be best managed. And again, Jeff, we see that coming through in the portfolio side of it.
Yeah, and it's very much thinking about how do we have portfolios that work for everyone. But also I think to that point of the beneficiary, thinking about, well, actually encouraging somebody to start and save at that early age as well. And that beneficiary program should encourage that, as it allows somebody to see the opportunity that they have as well.
Quite right. And I remember doing a presentation to the staff in True Potential saying, if it's £10 a month you can put away, that's £10 that'll work for you in the future. If it's 15, just put in what you can. You get a kicker from the government, you get 20% put back in, as we said before, money going into pension, that's tax-free. It's not when it comes out. The ISA is the opposite way around. But if you're looking to save, start saving early and as much as you can. Don't make yourself a pauper in your early years, but if you've got any spare cash, it's a great idea to put it to one side.
And that's very much, as Craig was saying, that's why you benefit then from the long-term return of the types of instruments in which we're investing. That's how you get that compounding effect that we're discussing right at the outset, but also access to the returns that one needs to earn to grow that pot through time.
Yeah. Okay. So to summarise, really, those who are coming up to 55, continue to save, continue to put as much as possible into a pension. When you get to 55, you don't have to draw on it. You can continue to save. You can get that accumulated pot of money, which is there to last you for the rest of your days. And probably you won't exhaust that. You'll have a residual amount that you can pass to the beneficiaries, tax-free, inheritance tax-free outside of your estate. So pension freedoms and flexibility has really been a great thing. Okay, everyone, I think that's it as far as we're concerned on pensions for today. Any further questions, please come into True Potential. Please send them in, and enjoy your weekend, or whenever you watch this. I hope you've had a weekend, a happy one, if it's Monday or Tuesday you're watching it, and we'll see you again next week. Thank you.